looks like we have some people joining. Zach, are we ready to begin?
I think so. We have 10 people on, so I think let's go for it.
Awesome. All right. Well, thanks everyone for joining us today. As a quick note, this video is being recorded, so to the extent that you have to drop off or you want to share this with a friend or a spouse, we'll have that information available for you. Also, we're going to have, there's a Q&A at the bottom of this, so to the extent that you have questions along the way, go ahead and drop those in the Q&A, and at the end of this, we'll spend most of our time today talking about or answering your questions. Really today, we're going to be talking about real estate, pretty heavy emphasis on real estate professional. This is the second rendition of this webinar that we're putting on. We did one a couple weeks back. Kyle, my colleague, on as well, hosted the first one. There was a great response, and people wanted another opportunity to kind of hop on and learn more about real estate and real estate professional and how that impacts their taxes. For those of you new to Nth Degree, I'll do a quick little bio about our firm, and then we'll jump into the discussion. So we're a CPA firm that's located in Seattle, helping folks with what we do is we do help people with tax and accounting, but really what we're good at is truthfully helping people get closer to the things that they actually want. And so if you ask a lot of accountants what they're good at, they're probably going to give you an answer, something very niche-y or something very specific as to what they do, or they'll mention that they're proactive or something along those lines. Really what we're focused on is people's their goals and their priorities. And I'll give you some examples today, but the impetus behind most of what we do is around planning and really trying to get people closer to the things that they're looking to achieve. Kyle and Zach, any other housekeeping items maybe before I jump in?
Just one thing, we're not set up as a webinar, so we're a meeting. So any questions that come up, just drop them in the chat, and I'll at the end I'll go ahead and read those off. But to the best you can, try to provide a little bit of context. So instead of asking, what does that mean, kind of specify. So at the end we can come and get through all the questions.
Awesome, thanks, Zach. All right, we'll jump into it. As an agenda for today, first we're going to go through a case study. I'm going to give you guys an example of probably a lot of the concepts that we're going to go through. I think it's best to start with an example. We'll talk about real estate professional status and what that means. Talk about short-term rentals, so that's kind of its own little niche area. And then we'll spend most of the time on the live Q&A. So as a case study, this is actually a client that I've been working with, just got done with their planning about 2 weeks ago. I've changed their names to Jane and John to protect their privacy. But quick facts, John's a doctor, earns about $500,000 a year. Jane, John's spouse, is a real estate professional. We'll go into what that means to be a real estate professional. She manages about 4 properties that both of them own. One of those properties they purchased in 2020. They paid about $500,000 for it. They're going to put about $20,000 worth of improvements on the property. The properties are expected to generate about $30,000 a year in cash flow. And so when I think about cash flow being how much revenue are they bringing in, what are their expenses, they're going to get about $30,000 a year across their properties. And really what it came down to, John and Jane's primary goal right now is that they want to expand their real estate portfolio. They want to basically grow their passive wealth, or really get more into real estate. John wants to move to part-time. He wants to spend more time with his kids. So after working with us, in terms of these facts, this is kind of what we were able to do. So we were able to write off $100,000 of the purchase price on their new property, which is about 20% of the cost, and we'll go into a little bit how they did that. They wrote off $120,000 of depreciation that their previous advisor had missed. And so basically they got another $120,000 deduction that had been missed from previous years. And they wrote off about basically all of their improvements. They had to write that off as a deduction as well. And so they're going to save about $80,000 in taxes by executing on these recommendations, which ultimately landed back to their goal, which is the most important aspect of it, which is that they wanted to basically expand their real estate portfolio. So now they have another $80,000 that they're going to use as a deposit on their next property. Now, taking a step back, this is in terms of how they did this. In terms of why people like real estate, I think it's important to start with why real estate's so special for tax purposes. And so taking another example, let's say you have $100,000 and you have the option between investing in a stock that's going to pay you a 3% dividend, or you could invest in a property that's going to give you $3,000 in cash flow. Now, you'd probably say initially, like, those are the same. Where tax advantages come into real estate is that you're probably, in most situations, going to pay tax on that dividend, whereas you're probably not going to pay tax on that real estate income. And the primary reason for that is what's unique about real estate is wear and tear, or it's formally called depreciation, is that unlike other types of investments, when you purchase the property, you get to write off over the value of time a portion of your investment. And so what's cool about real estate is even if I put $100,000 down on a $500,000 building, I still get to claim wear and tear expense on a $500,000 building. So because of those reasons, most people, even if they're not actively involved in real estate, don't pay taxes on the real estate cash the cash flow that they're generating. And so one of the most unique aspects of real estate that you just don't get with other types of investments. The other thing is as people make improvements in real estate, if I had $1,000 of Google and I bought another $1,000, I don't get to claim a deduction for my additional investment. With real estate, as I make improvements, in most situations using some of the advanced tax techniques that we have, most of the time people get to write off those improvements. And so as they invest in the property and invest in their ability to generate additional income, they generally get to write that off along the way. So kind of unique to real estate. Starting with maybe somebody who just has their first real estate property, you're looking to rent it. Starting out, real estate is a passive investment. And so that distinction is important because basically if I have a loss on real estate, which I talked about, most people have losses because of depreciation, their expenses offset their income. I typically don't get to use that loss to offset my other income. Now there's some unique aspects to being a real estate professional where you can, and some other aspects that we'll get into. The other thing about passive losses is that they're limited by your passive income. And so what does that mean? If I have $3,000 in losses from real estate and I have $3,000 of income from my W-2 job, I don't get to offset that income. Now, if I had $3,000 in losses from real estate and $3,000 from a partnership that I own, maybe I have an e-commerce business with a friend, I could use those losses potentially to offset other types of passive income. So real estate professional status, which we'll go into, that is where you can convert your passive income into active, into an active activity. And so what is a real estate professional? Well, really there's two tests. And so most people when they hear real estate professional, they think, well, like I don't buy and sell houses, like that's a real estate professional or somebody who builds houses. You don't necessarily have to do that. Really what the IRS says is you have to have more than 50% of your work in real estate trade or business. So if I have a full-time job as a doctor and I'm trying to get to 50% of my time, I'm probably gonna have to get like 2,000 hours in real estate. So that'd be a really hard bar to do. So usually where we see this is somebody who's maybe working part-time or they're full-time in real estate or their spouse or significant other is working in real estate. The other activity is 750 hours in real estate activities in which we materially participate. And so that's I intentionally put that in bold and underlined, material participation. Just because I have 750 hours, I have to be materially participating in the activity. So like, what does that mean? It basically comes down to, the IRS has some specific tests, but the idea is they want you to actually be involved in real estate. So if I have 3 rental properties and I'm just hiring, I don't want to be involved at all. I'm just going to hire property managers to do all the work for me. And I'm going to have 0 involvement in the properties. I'm not materially participating in those activities. And so material participation, there's a bunch of tests. If you look this up online, you'll see like 7 tests. It really comes down to these 2, which is, do you have more than 500 hours? And so if you break that down, 52 hours or 52 weeks, probably at least 10 hours a week, or more than 100 hours and more than anybody else. And so that's the example of I need to have 100 hours, but I have a property manager that does 150 hours. They've done more than me. And so I would have needed to have gotten to at least 500 hours in that activity for that to count. So 2 different tests there. A lot of people, the other question we'll get on this one in particular is, how do I get to, if I get to 500 hours in the activity, can I use things like research in real estate for the other hours? Typically, yes, as long as there's a business purpose behind it, you usually can count those hours. Question we typically get is, how do I prove that I'm a real estate professional, or what is it that I do to have to prove it? Really, the burden of proof is on you, and so you really got to track your time. And so if you have 2 jobs, you probably need to track your time in both your real job, your main job, and your real estate, because you have to get over that 50% threshold, or have some sort of log. And so having a timesheet log, having a calendar and email system, something that tracks all of the time that you're spending on your real estate and actually involved in it. You want to track all of that time, track it real time. Clockify is a free tracking app that a lot of real estate people use. It's been recommended to us by a lot of people that are in real estate. Is a common example of how to track your time. In terms of what activities qualify, development, construction, acquisition, rental, managing properties, leasing, brokerage, those are the typical activities that qualify in order for you to be a real estate professional. One thing to note here is typically one of the things I'll see is maybe somebody is a real estate professional. Maybe they buy and sell houses, but they are an employee of a company. Your hours spent as an employee of that company would only count if you owned more than 5% of that company. So not super common. Most people that I know in real estate are paid as contractors, but to the extent that anybody here is working in real estate, buying and selling properties, and you're paid as an employee, those hours wouldn't count. If you're paid as a contractor, you have your own company, those hours would. Commuting to and from the properties. So I live here in Seattle. If I've got a rental over in Spokane, and I'm going to check on that property. One way that I can count the time that I'm spending between those particular items is if I have a home office. And so establishing a home office is an exclusive use space in my home. It's for managing my real estate activities. Doesn't have to be an entire room necessarily. It just has to be an exclusive use space. So it could be a 2x4 area within a room. Doesn't have to be partitioned off by walls or anything like that. So establishing a home office allows me to count the hours commuting to and from the properties. And then, as I mentioned, researching property time and travel. Sometimes it's not included. It depends on the activities. And so we kind of treat that on a case-by-case basis. Because it's sometimes hard to hit 750 hours, especially if people have another job, or maybe you're just getting started and you only have a couple of properties. What a lot of people will do is this grouping election. And so giving you an example, let's say I own 3 properties, and it would be really hard for me to get to 500 hours or 750 hours across those activities. What I can do is I can treat basically all 3 of those properties as one economic unit. So I could say, okay, maybe I got to 200 hours on property A, I got to 300 hours on property B, I got to 400 hours on property C, but maybe property A, I had a property manager and they did more than me. in that activity. And so I want to be able to treat all of these properties as one unit. So that way I could say, hey, I've hit material participation in that activity. I got to 750 hours, I got to 500 hours in that activity between all of those properties. And so we look at that on a case-by-case basis. The other thing we look at is, were these, would you potentially dump these properties? Are these properties that you maybe want to get rid of in the future? And have you previously used these properties as passive activities? So maybe you weren't a real estate professional in the past when you own these properties and you've got a bunch of what we would call carried forward losses. Really maybe super in the weeds there, but more, if you take away anything from this, the grouping election is great, it's available, but it's definitely something that you need to work with an experienced advisor on. What if you don't qualify for real estate professional? So I have a lot of people who will start, a lot of doctors that will start with, they'll start to get into real estate, they'll buy a couple of properties, they'll get to the end of the year and, oh shoot, I didn't get to real estate professional status. Did I just waste all of my time? Not necessarily. You know, if you have passive losses that you created, yeah, you can't use those to offset your income, but you can carry those forward. And so, you know, if I sell the property a couple of years from now and I have $100,000 of gain, but I had $60,000 of losses carrying forward, now I can use those once I've disposed of the property to offset that gain. So they don't just go away. And so even if I don't hit rep status, there's still potentially a benefit to owning real estate. And number two, I've kind of hinted at, which is the idea that I can create cash flow, positive cash flow, and have basically taxable loss via that depreciation deduction. So even if I'm making money on the property, now I don't have to pay taxes on it. So it can potentially be a great situation there. On the real estate professional stuff, short-term rentals. Let's say, let me start with an example. So let's say I own 4 properties. So going back to kind of my case study, but property D, the 4th property that I bought, is going to be a short-term rental. So I'm going to, primarily people think of Airbnb. So I'm going to Airbnb this one. Maybe it's in a really good touristy area. So I have clients that have properties in New Orleans, for example, or Seattle, where they can Airbnb, and that's going to be a better situation for them. Those hours that I spend on the short-term rental, those don't count towards real estate professional status. And that's because short-term rentals function very differently. Basically, for short-term rentals, it's treated similar to like a hotel. So if you think of a hotel, it's kind of different than your like long-term lease situation where you have a tenant and you're signing a 12-month lease, something like that. Short-term rentals, Airbnb, that style, basically where you have the average rental is 7 days or less. That's going to be an active trader business, basically. So normally rentals get reported on Schedule E. That's where it shows up on a tax return. These would get typically treated on Schedule C. So if I did have income on it, it would be subject to income tax or self-employment tax because it's earned income at that point. The nice thing about short-term rentals, where a lot of people will start with short-term rentals, especially if you're in a situation where maybe you have maybe one or 2 people within the household, both of them have jobs. And so I want to get into real estate because I want to take advantage of the benefits of it, but we're not going to be able to build up our real estate portfolio big enough yet to get to a place to where we're going to hit this real estate professional status. Like I'm just not going to get to 750 hours. Well, if I have material participation in a short-term rental, and so as you maybe remember, that's a lower bar. So if I had 100 hours in the short-term rental, I'm doing an Airbnb, I'm sending people the codes as they're checking in to get into my house, and I'm doing more of the activity than anybody else. I hit 100 hours, more activity than anybody else. Now that's a property where I can use the losses to offset my other income. Where this, going back to my example, where this, the case study where we help these people, where this really comes into play, where people really like this as a tax benefit, is when I talked about depreciation. Usually the way that works is basically you take the property you own and you have to basically claim wear and tear expense over a really long period of time. The IRS has these arbitrary default methods. It's 27.5 years or 39 years. And so if I had a $275,000 building, I'm only getting $10,000 per year. There's some advanced tax mechanisms called a cost segregation study, if you've heard of it, where basically it gives you an opportunity to write off a larger portion of the building by looking at things like the refrigerator in the building and all of the fixtures and this stuff that basically qualifies what we call bonus depreciation. So fancy way of saying basically I can write off a lot more of the purchase price in the year that I purchased something. So why this is useful. Again, I get to a situation where I want to get into real estate. I can't quite get to rep status, but maybe I can use this short-term rental. Maybe I can get to 100 hours this year and participate more than anybody else. And now I can take advantage of some advanced tax mechanisms that I couldn't because I couldn't hit rep status. And so kind of some pros and cons to both, but something to consider. Maybe pause here before we jump into Q&A. Kyle and Zach, was there anything that that you guys wanted to add?
Yeah, thanks, Chet. Appreciate you going through all of that. You know, I think definitely on this, the short-term rental is an area where I've gotten a lot of questions, specifically with kind of people getting different answers from different tax preparers in terms of whether your short-term rental goes on Schedule E or Schedule C. Is it a rental or is it an active business? What really differentiates between that active business or it being considered a long-term rental? How do you make that distinction?
Yeah. So typically you're performing or some sort of service is being involved. And so if you think about a hotel versus like a long-term stay situation, this is this example. You know, if I'm renting a property for a year, nobody's going to show up to change the sheets or do turn down service or anything like that. Whereas a hotel, I'm certainly expecting fresh sheets and linens to be prepared along the way. And so that's really what it is. And so that's my example. It's really, there's some sort of service that's being performed, which is typical in an Airbnb. Usually you have to clean the sheets before somebody comes into the property next.
Awesome. Other question on grouping. So when you're grouping activities, do you need to group all of your rentals or can you pick and choose which ones to group?
Yeah, you definitely can pick and choose. And sometimes that's important, especially depending upon what you're going to do with the properties and really what the history of the property is. And so, you know, let's say I have a property that has a bunch of passive losses on it. I've owned it for a really long time. It was the common situation. It was my first house. I moved out of it. I flipped it into a rental. And then I found out a couple of years later about this real estate professional thing. This sounds awesome. Let's get one of us into it. And all of a sudden people group that property in with all these other properties. It might be that that's not a good move if that property is something you're going to sell in the next couple of years. And that's because once I've grouped that property with all this other stuff, now I've got all those losses that I've accumulated that I potentially can't use in that situation to offset the gain in this particular sale. So the grouping, it sounds really great. It's definitely something that should be reviewed on an annual basis. And we should really be talking about your goals, your priorities. What is it that you think you're going to do? And then really looking at what is like the rate of return and kind of what are you expecting this property to do relative to other types of investments.
Awesome. Last one, and you touched on this briefly, I think in your case study, but can you talk a little bit about the opportunity to go back and do cost segregation studies on properties that you may have purchased several years ago?
Yeah. So we see this a lot. You know, people come to us, they've qualified as a real estate professional for years, but in terms of depreciation, wear and tear on their building, they've claimed they basically have allocated a massive portion of the building to this really long cycle. And so what you can do is you basically hire a professional. It's an engineer. They go to your property. They basically identify land improvements. They identify all the stuff that really isn't structural to the building. That's really what they're looking for. They're looking for things that what's truly not the building. It's like the other stuff. And that stuff we can, instead of depreciating or expensing over a really long time, now we can take all of that now. And so what they can do is basically the IRS has a methodology for you fill out a form. It's pretty complex, but the idea is you're saying, oops, I screwed up. I should have actually been. It's called a 481A adjustment. It's a super technical term, but the idea is you're saying I screwed up. I should have claimed all of this depreciation in the past. So now I'm going to take it this year. That is also a very unique aspect of tax planning. And so let's say I had this example of a client more recently. Let's say that I have $300,000 in income this year, but next year I'm getting a huge commission. I'm getting a big bonus, or COVID has impacted my income this year, but next year I'm going to have a really high tax bracket. It might be better to do the cost segregation study next year, because that's when I'm going to get that really massive deduction.
Awesome. Thanks, Chet. Zach, how are we doing on questions there?
Good. Yeah, we got a couple questions. So I'll start feeding them to you, Chet, if that's all right. And just a reminder, everybody, feel free to drop your questions into the chat. We have 2 right now. So we got some time to answer. So feel free to fire away. But Chet, for the first question we have, so if I am part owner in a hotel, does that go on Schedule C? And are losses active?
Yeah, good question. Typically, if you're a part owner, my first question is going to be, what's that economic relationship look like? And so usually when I hear part owner, that's going to be part of some other return. So usually by default, if there's more than one owner, you're either going to have a partnership or you're going to have a corporation or something like that. So that would all be reported on a separate tax return. Typically, it'd still be prepared in a similar fashion that maybe a Schedule C would, in the sense that it'd be like active income on this partnership, and you could do all these types of all the advanced tax planning stuff that we do within that partnership realm. But it'd be reported on a separate tax return, which would then usually flow through to you. So that's the typical situation.
Awesome. And then we have another question. So it's, if I have a home office and my property is far out of state, then is driving to and from, so it's driving to and from counted as hours. And he then says, I would normally fly, but due to COVID would drive. Yeah.
I would say yes, simply because especially because of COVID, I think it really comes down to, is there a business reason? Is there a case that you can make that there's a business case for it? So I've got the home office and it's really tough to fly right now. So maybe it's really far away, maybe it's across the country, but if there's a business purpose, I need to go check on my properties there. I have to do that as part of, similar to any other type of business. If you think of a business owner needed to go check on the operations of his business and it was a ways away, and he was fearful that there was going to be some sort of economic impact, which there could be in real estate, that's certainly reasonable. It's reasonable for you to go drive there and check on the property.
Perfect.
Yeah. Hey, Chet, just one more point on that.
Yeah.
I assume that question's coming from a place of it probably costs a little more to drive versus fly. And so, in that regard, there's nothing in the tax code that says you have to use the cheapest option in order to get a deduction. And I think that's something that often catches people, is they assume that the IRS is going to expect you to go with the lowest cost alternative anytime you're incurring an expense in your business, and you don't have to. As long as the cost is ordinary and necessary in the course of the business that you're doing, you can take that deduction even if you took the first class ticket instead of the coach ticket to wherever you're going, or if you drive instead of fly.
Perfect.
Great point.
Then we got a question. So regarding timeline for cost segregation, start in 2020, end in 2021. Then the question is, when can I apply for it?
Yeah, great question. So typically what I tell people as it relates to a cost segregation study is like normally people think like I bought the property, I'm going to do a cost seg. You can do it. So if I bought the property in 2020, I could wait to do that cost segregation until 2021. It doesn't have to be done in the year that I did it. So I can do the cost segregation later. I could do it so that I could apply it before my taxes for that year if that made sense, or I could do it 2 years from now if that made more sense.
Cool. Then we have another question. I own one door, my family owns another door. If I manage that property for them, but don't own the door myself, would that count towards reps?
Yeah, good question. Yeah, so you're basically your activities in that particular interest are real estate activities. I think I would count that, wouldn't you, Kyle?
Yeah, I would say as long as we go back to that employee test you mentioned, as long as you're not an employee, like a W-2 employee of the business that owns that rental property, if they're contracting you to do property management, provide property management services, that would fall under the kind of the umbrella of real estate activities.
Yeah, that's great. Yeah, so I worked with another client a week or so ago. Husband is in the construction business, building properties and stuff like that. She is going to be the real estate professional in the sense of she's going to be the one managing rental properties. So he already hits real estate professional status on his own. In her case, she's going to be doing material participation in these other rental properties. And so to the extent that in your day business doesn't have to, a lot of people hear this and they immediately think rental properties. It could be that I have other trades or businesses in real estate, and that's my full-time thing. Based on that, I probably hit real estate professional, like I'm a real estate professional alone. So if you think about the intent behind real estate professional status is really what Congress is, the reason that they pushed this or what this idea was, is that you're somebody who's in real estate enough that this is an active trade or business. Like you are hitting, the reason they have these hours and the time requirements is, 50% or more, 750 hours, you're actually in real estate. You understand real estate, you're spending the time to do it. And because of that, it's really more of an active trader business for you. It's not really a passive activity. It's different for you. You're different all the time.
Perfect. Then, so we got a question, which is a great opportunity to drop this plug. So what's the process for onboarding with your company? And then has a more specific question. So feel free to shoot me an email. My email's at the bottom of this thank you slide here. I believe I've emailed most of you at some point. So the first step is basically we'll hop on a call and kind of discuss kind of our process and our tax planning, but happy to go through that in more in depth with any of you. So feel free to reach out to me that email address. And the following question from there is, how do you approach deciding what should be depreciated versus written off as a repair?
Yeah, that's a great question. I love that question. So in terms of how, basically there's 3 steps. So the first thing is something a repair versus something that has to be depreciated or an improvement. So you start there. And repair is generally something to bring it back to like normal operating condition. And so I'll see people that will list something as an improvement sometimes coming from other accountants where it was like, yeah, my pipes burst and basically like I had to have a bunch of work done. It's not like they installed an entire new system. It's basically they needed to get things back to normal operating condition. That's a repair. If something is an improvement, then there's a couple other tests that we look at. One's called the de minimis threshold. It's basically is something insignificant. There's a couple different thresholds that you can work with. The most common is it under $2,500, and so. And that's $2,500 per item. So for example, if I had a bathroom remodel and I had a $2,000 vanity and I had the floors were $2,000 and maybe I had $2,000 in furniture or fixtures within there, I could say that each one of those is small enough to write off. So I'm going to call that a de minimis item. And the last thing is a lot more complex, but it's the idea of, it's called the partial disposition election. And so what you can do here is basically if you're removing a component of the old property, so probably a good example is like a roof. I have a roof repair. The old roof is gone. and I'm putting on a new roof. Well, basically through some calculations, we can write off of the value of the old roof. So as if you sold it for $0. So we can claim a big loss. And that was that's the example that I hinted at in my case study, which is where that $20,000 in improvements. That's how we were able to write off all of those for the people. It's basically we went through those 3 tests and basically identified how we would write them all off.
Awesome. Then I'm going to group 2 questions into one here. So do you have clients with international properties, and can internationally owned properties count towards reps?
Chet, you want me to take that one?
Yeah, I'll let you take that one.
Cool.
Kyle on our team has a lot more experience with the international components of this, so I'll let him tackle that.
Yeah, thanks, Chet. Yeah, my background prior to joining at Degree, I worked for a firm that specialized in international tax. So got a lot of background in that area. Yes, your international hours can qualify for reps, and there's nothing that in the reps rules that say really anything about international or domestically owned properties. So total fair game there. We do have clients that have properties internationally. The one big caveat with international properties is around depreciation. So those benefits of the cost segregation study that Chet mentioned, there may still be some benefit in doing a cost segregation study with an international property, so you can look to shorten the the depreciable lives of assets. But bonus depreciation, Section 179, these accelerated depreciation methods, these are not available for international properties, and that goes back to the intent behind those programs. So Congress, through setting up bonus depreciation in Section 179, they're really looking to incentivize investment in capital assets here in the United States, and so they don't make those programs available to international properties. So anything international is actually subject to its own depreciation system called ADS, or alternative depreciation system. Generally, you're going to find that the useful lives or the depreciable lives on foreign properties are slightly longer and less favorable than those properties here in the States, but still count towards reps. So can be helpful from that perspective.
The other thing to consider on international properties is around asset protection. And so we're not attorneys, but we do see situations where some of our international or clients, where they'll put properties in things like foreign trusts and stuff like that for asset protection purposes. There's a lot to consider around just like U.S. reporting and kind of the additional compliance costs for that. So if that's something that you're looking at is international properties, which can be some really great yields in international in other countries on properties, which I know why a lot of people look there. When you're working with an international attorney to establish a property there, something to keep in mind.
Good point, Jeff.
Cool. And then, so I understand for the 500 hours material participation, it can be split between a couple, as long as the one claiming reps has 750 hours. If my spouse and I both drive together to a rental for 10 hours, are we both able to claim 10 hours of material participation?
Yeah. Yep. Yeah. As long as, you're both, the intention is that, you needed both of you there to work on that property. So
cool. And then does staging and decorating the property count towards material participation?
I'd say absolutely. Yep.
Cool. That's all the questions we have in the feed, guys. Maybe we'll give it a couple minutes, a minute here to see if anyone else has any other questions. Otherwise, we'll wrap it up for the day and give you guys 20 minutes back. Cool. Well, I don't see anything else coming in, so I think we'll end it there unless either of you have anything to add.
I think we pretty much covered it.
Cool. So just to repeat, I'll be the one to talk to you if you're kind of interested in doing some one-on-one planning, or if there was a question you were kind of nervous to ask in kind of a public forum like this, just send it my way and I'll get it in front of the team. But regardless, thanks for joining. We'll be sending out the this recording to all of you if you're interested, and feel free to pass it on to your friends if that's if they'd benefit from it. Cool.
I think another question just came through.
Does reps affect audit rate?
Yeah, that's a great question. So as a CPA, we can't necessarily comment on audit rates. Our code of ethics prevents us, and that's intentionally. So people, what we tell people is you're 100% any deduction that's available, including all of the advantages of reps, to the extent that you can hit those bars and do that, you absolutely should take advantage of those deductions. So does it increase our audit rate? We don't know, truthfully. You'll see articles that'll come out that'll say this kind of stuff. The reality is that there's no basis for that in terms of like how things are being audited. So we don't know is the real answer, and we don't want to sway people's opinion based on that. And so to the extent that you can hit real estate professional status, you should 100% take that deduction. Just do the things that are necessary, such as having a time log and that kind of stuff available, and then work with a professional that can kind of coach you on everything you need to do. That way you're, if the IRS ever does ask for substantiation, you can say, here you go. Here it is. And hopefully they go away quickly. So.
Awesome.
Yeah.
I
I agree, Chet. I think it's important to note that the IRS they don't share the information around what might trigger an audit. And so it's sort of a black box there. People can speculate all they want. The information's not out there. So it is what it is.
We actually have one more question here. So yeah, can you choose which year to apply bonus depreciation? I was told best strategy is to do study first, make renovations, then finish the study. If the repairs start in 2020 and end in 2021, can I pick?
Yeah, good question. So typically most taxpayers are cash basis taxpayers. So when that check is cut, that's ultimately when when you have to apply. Basically, you cut the check. That's when you paid for a particular improvement. That's when you have to use bonus depreciation. It's rare, but there are some instances in which people will opt out of bonus, and so you'll intentionally stretch that out over a period of time. So maybe there's a situation where somebody they'll do a cost segregation study, and they'll maybe opt out of bonus on their 5-year property. And so some of the property they'll take over 5 years as depreciation. And so there's some situations where we've looked at planning for that. But for the most part, it's going to be when you paid for the particular improvement, that's when you got to take bonus.
Yeah. Bonus depreciation in its nature is a first year deduction. So it's only available in the first year that a property is or an asset is put into service. Chet did call out that opportunity to go back and claim missed bonus depreciation by basically filing for a change in accounting method and saying, throwing your hands up, saying, hey, I missed this opportunity in the past. I want to go back and claim it. The one note there is you do have to establish 2 years of filing under the non-bonus route. And then after that 2 years, that allows you to establish an existing accounting method. At that point, you can go back and say, hey, I'm switching this. And then you can flush through that missed bonus depreciation in that later year.
Cool. And we got a follow-up question to that. So what about when doing renovations and you are paying the contractor in parts, i.e. some upfront, some when 50% is done, and some when project is completed?
Yeah, barter transactions. Yeah. So typically if there's a I think that's what you're asking is what to do if you have a barter situation.
I think what they're saying is they've paid in installments.
Okay. Yeah. So in terms of, if I paid in installments, maybe I paid, $50,000 now and I paid $50,000 next year. I would take $50,000 this year, $50,000 next year. The period would be split out. It wouldn't be like I could take all 100 now.
Yeah, and then the other note on that is we go back to that placed in service test. And so if I'm paying a total of 100,000 towards some improvement, it's once that improvement is placed in service, that's when I would have the opportunity to take bonus depreciation and to begin depreciating that cost. And so if the 50,000 I pay this year is towards, some development, but that is still a work in process and hasn't been completed enough so that it can be used, I would take that bonus depreciation in that subsequent year.
Cool. And then we have a question. Is it a good idea or necessary to have a CPA if you're not going for reps? I would say I'd be happy to hop on the phone and kind of talk you through kind of if working with us makes sense. But Chet, Kyle, anything to add to that?
Yeah, it absolutely can. It really depends on kind of your goals and kind of what you have going on. Like Zach mentioned, you can hop on the call with him. We'll tell you, we're definitely honest when we say, oh, you know what, your situation, here's what you need to do. You just probably don't need an accountant. And so we'll let you know.
Absolutely, yeah. And then with reps, do you aim to just shelter this spousal W-2 income at the higher tax brackets and in parentheses above 30%, or the entire W-2 income given the arbitrage with the depreciation recapture?
I'm so sorry,
Yeah.
it kind of cut out there.
I can jump on that one, Jack.
Okay, sorry.
Like Chet said, it's going to go back to your priorities. So we definitely have clients that are super aggressive and want to go after kind of maximum tax savings, at any cost. And so, they're on an annual basis going out and buying sizable properties so that they can push through really big deductions. Other people are less willing to put so much into their real estate investments, so they want to hedge a little bit. So take on less risk by buying properties here and there, getting a nice tax savings, but also managing that level of risk. It more comes back to aligning with, what's the ultimate goal that you're trying to achieve, and saving on taxes probably is more of a secondary goal to what you're really ultimately going after, whether it's building out your real estate investment portfolio, trying to get to a place where you have enough free cash flow to retire a spouse, or recognizing some getting back some hours per week, maybe 10 hours a week or something. You probably have some other goal short of just paying less money to the IRS.
Yeah. I think with any financial situation, I don't think there's a single client that ever comes to us and says, I want to pay more in taxes. I think everybody wants to save money on taxes. But usually there's an underlying reason. And so that's really what we do, and we try to understand that. For example, I have a client that I'm working with who says, I want to work forever. I don't ever want to retire. And so that usually throws off a lot of financial advisors. They're like, well, I don't know how to calculate if you don't have a retirement age. We usually kind of laugh at that. We chuckle at it in the sense of like, that's perfectly fine. And usually the follow-up question is, would you like to be at a place where if you needed to retire, you could? Like, well, yeah, of course. I'd love to have financial independence. And so, okay, well, let's look at a number for that. Let's work for that. And then everything else you can do beyond that, like, let's look at your other goals. Would you like a vacation property? If you want to help your parents out in retirement, whatever it is. Let's look at planning specific to that.
Awesome. And then are there any real incentives to improving a property via landscaping from a tax perspective?
Yes. Yep. Absolutely. So I guess it would depend on what the use of the property was. And so like if this is a investment property and I'm spending money on landscaping, there's multiple ways I could potentially tackle that, those expenditures to treat that as a deduction.
Cool. And then we got a question about the fees to work with us. And again, I'm happy to discuss those. It kind of depends on the person and your situation. So shoot me an email and we can discuss in more depth. Then we have one more question here, and is it more difficult to prove material participation hours for a property that is out of state? I heard that the IRS is skeptical of participation because property managers are usually in place.
Is it more difficult? Probably, probably like in some regard. That doesn't mean that you can't hit that threshold. It's probably more a situation if you're gonna have a property out of state, where I typically see this situation where somebody still hits reps, is that they own a lot of properties and they're gonna use it to take advantage of that grouping election. And so, could I spend 750 hours on a property out of state? Absolutely, I could, especially if it's a big property. Maybe I'm managing a lot of it remotely. But it's in terms of, is it a little bit more difficult? Probably. It's probably more difficult than something that's local, just simply because there's more opportunities to go participate in that activity on a local property. I can actually go see it more frequently. So
yeah, I think it's important to note on that one. If the question is it more difficult to prove material participation? I wouldn't say so. I'd say if you've kind of substantiated your time, you've tracked it, you've shown the activities that you've performed and the time that those activities took, and you have that level of documentation, I don't see why that would be more difficult to prove.
yeah,
I think to Chet's point, it's just more difficult to reach that those hours tests if the property's out of state, just because there may not be as many opportunities to engage in qualified activities.
Awesome. And then if one were to generate a net operating loss from reps, do you recommend carrying that loss back or carrying it forward?
Yeah, great question. It depends. I hate to give people. It depends on your goals and what you're looking to do. So, things to consider. Generic things to consider are, what would you do with that cash if we got that cash in your pocket now faster? What are tax rates? What are the tax rates today versus what were they back then? What were you paying? There's a lot to consider there. And truthfully, that kind of decision could be one in which could be thousands of dollars and that you could save by making the right decision, or it could be that it really allows you to, or it allows you to fund a goal that you couldn't otherwise. So we could get to a certain goal faster. If we carried it back versus carrying it forward. And so it really depends. It's a great question.
Awesome. So that's all the questions we have. I appreciate everyone's participation. I think Chet and Kyle, I think you'd agree that these go a lot better when we have folks who are asking questions and we can answer those.
Absolutely.
Again, feel free to shoot me an email if you guys want to discuss kind of more in depth, or if there was a question you didn't feel like sharing publicly, happy to discuss that offline. But Chet, Kyle, thank you for your time, and we'll end it here.
All right. Thanks guys. Thanks everyone.
Thanks guys.
Good talking to you.